So this is part 3 of beepurple's mini video series about business finance made simple. And in this video, we're going to focus on cash flow forecasting. So what you've got on your screen right now is an example of a mini cash flow forecast. And what I'm going to do is explain it in a way that makes it seem really quite simple. For some people, it can be quite daunting, a bit scary when you first see something like this. I suppose because of all the numbers and the rows and columns, it might seem unfamiliar. And some people are just not that comfortable working with numbers. But I'll explain it in a way that really makes it seem not that scary, and you'll realise that it's just a case of adding and subtracting. So we're going to come back to this example in just a moment. So what I'm going to cover is cash flow forecast. What is it and why it's important? Run through that example that we've just seen a moment ago, and then as usual, I'll give you our contact details at the end. So a cash flow forecast, what is it? So it's a useful planning tool that helps you predict and monitor your cash position over a set period of time. So that's the important part right at the end. So you're introducing the element of time into it. So it's not just a case of looking at how much money comes into a business and how much goes out of it. You're also looking at when those things happen. And so an example that would show you why this is so important is when you're running your business, it might just be the case that your rent is always due to come out on, say, the 20th of the month. And you might collect payments from customers, but then you find that the cash doesn't actually hit your bank account until the 25th of the month. So your rent is due on the 20th, but yet your money isn't coming in until the 25th. So what it enables you to do is see where you're likely to be short of cash in some areas. So then what you can do if you identify that is then think to yourself, okay, you can either inject some cash into the business or maybe arrange an overdraft. And it's always better to do those things in advance rather than having to go into what they call an emergency overdraft and attracting fees and fines and that sort of thing. So why is it necessary? Well, it's really good just as a planning tool. Again, it's one of those things that you can do which makes you realise that if you want to have a serious business that isn't just a hobby that doesn't really make you any money, you need to introduce planning, and this is one really important planning tool. So it will help you understand how much cash you're likely to have and when over, let's say, 1 to 2 years and possibly 3 years. It's not one of the sexy parts of starting up a business. It's not necessarily exciting, but it's really necessary. And of course, if you're looking to raise finance, whether it be through applying for a grant or funding or looking to get some investment, then they'll always want to see a business plan, and a cash flow forecast is an integral part of that business plan. So just so I can explain how it works and how it's relevant, we're going to look at that example that we covered right at the beginning very briefly. So this is a mini cash flow forecast that you can see in front of you right now. So I say mini cash flow forecast because, like I say, normally you'd want to cover at the very least a year, and normally anywhere between 1 and 3 years, and sometimes doing a best case scenario, worst case scenario, so you can take an average. But this has got all the important elements you'll need, so I'll just talk through them one by one. So at the top, what we do is we say what our time period is. So here, this is a fictitious example, but it's still got all the elements that you need. So going back to the time. So this is, let's say, September through to February. So I put each month one by one in a column up here. And then on the left, the first thing we do is we list our income. So let's just say this is a household where you've got money coming in from 3 sources. You've got someone paying rent, called Sam, you've got someone called Laura paying rent, and you've also got rent coming in from Airbnb. So this is a business that they're thinking of starting. Well, it's really a payment from Airbnb rather than a rent. So you've got rent coming in from Sam, rent coming in from Laura, and then this is the income that they're forecasting. So this is all income, this part here, under the heading income. So underneath, what you then do is you total all that income. Then beneath the income, you've got expenses. So here you list all the expenses that are going to come out of the household. Sam and Laura will say, okay, so we have to pay gas and electricity every month. This is how much it is. Oh, our water costs this much, and so on. And then what's really handy about doing a cash flow forecast is you can add in unusual payments that only happen once off. So you can add in a row here, and in the month of September 2015, we can see that there's a payment to Sandra, but doesn't get added in these other columns here. So we've got total income so far. We've also now got total expenses. So you can see where this is heading. So for this month, what we can see is what they call a net cash flow of £69.14. So that's just a fancy jargony term, which means the difference between the amount of money that's coming in, so the income, and the amount of money that's going out, i.e. the expenses. So here we can see, because the income is greater than the expenses, we have a surplus of £69.14. It's just income minus expenses. And then this is where it gets really quite interesting, is that you look at the amount of cash that you had in your bank account at the start of the month. So let's just say, again, this is all made up. In the start of the month, we had £494.36 at the start of the month. Then what we do is we say, well, if that's the amount of money we had at the start of the month, given that there's this surplus, how much will we have at the end of the month? So the amount of cash that we have in our bank account at the end of the month is called the cash position. Again, it's a bit of a jargony term. It's not, I don't know if it's necessary, but it's what people call it. So cash position, it's the amount of money we had in our bank account at the start of the month, and then whatever this is. If this is a surplus, you add them together and you get that much. And then you can see it's just all repeated again month after month. But you see how this all links together. So this month, you see that, so the income, the total income, so Sam's rent, Laura's rent, and the Airbnb income totaled only 1,167. Now the expenses this month were 1,219. So that means we don't have a surplus this month. We are £52 down. So income minus expenditure, expenses, gives us minus £52. So we say, okay, well, if we're at the start of the month, we had £563.50, which is carried over from here. And we have a loss of £52. That's what gives us this figure. So just run through that one more time. So this was the cash position, in other words, the cash in our bank account at the end of September. So then we know the opening bank balance for October is the same amount. So in this particular month, we've got a loss of £52 because our expenses are higher than our income. So then when you take £52 away from £563.50, this is what you're left with. So really, that's how a cash flow forecast works. It's just seeing how income and expenditure changes over a set period of time. But why it's important is because you can see that if you have a couple of slow months here, as we do in October and November, then you see your bank balance, having been quite healthy in September and October, ends up being negative in January. So it has a knock-on effect several months down the line. So what that enables you to do is get on the phone to your bank and say, look, I've done my cash flow forecast, and it looks like in the months 10 and 12 of 2015, or whatever it may be, we're going to be into an overdraft. So can I please arrange an overdraft? So that's good, because rather than kind of having to arrange an emergency overdraft and incurring all these fees, you'll just probably have to pay a bit of interest. Or you can inject some cash yourself so that you're not running into trouble. So these are the key elements of a cash flow forecast. So like I say, really it's just a case of adding and subtracting. Now there are templates out there that will do all of the calculations for you automatically. So they will automatically carry, say, this figure over from here over to here, and so forth. So you can build an Excel template yourself, it's very straightforward, or you could just use one that's already out there. So that's the end of part 3 of the mini-series about business finance. So just to remind you what beepurple can do. So we offer one-to-one business support, Wednesday evening workshops, competitions, and our summer course. And the way that you can access all of these things is through the website, through sending us an email, or giving us a call. And then, of course, we've got our social media platforms, Twitter and Facebook.